since it is Memorial Day weekend coming up, means markets are closed on Monday. So don't be surprised if the markets sell off a little bit tomorrow. Just people not wanting to hold over a long weekend because there's just too much stuff that happens in Washington every week. You don't know what Donald Trump's going to tweet one day to the next and how that's going to impact the market. So traders are starting to get a little bit more skeptical about holding over weekends. So don't be surprised if we get a little bit more of a sell-off tomorrow. Today's action and yesterday's action continues to be very supportive of the current support level. This is good from a short-term standpoint. Now, we've been talking about here over the last couple of weeks that really this move up in the markets, we moved up above resistance. If you're watching our live stream right now at facebook.com/realinvestmentadvice or simply go to our website, realinvestmentadvice.com, you can actually watch our live stream and see the charts that we're talking about here. But over the last couple of weeks, we talked about previously going back here over the last couple of months about raising some cash during that decline and just having a little bit of an overweight position in cash. Again, we're invested longer term within the primary core of our equity holdings, but sometimes taking a little bit of money out of the markets just to let markets go through a corrective process not only reduces the volatility in the portfolio, but also allows you to have less emotional stress so that you don't make trading mistakes and you don't make investment mistakes that impair your returns longer term. However, when the market broke up here above this very important resistance level right at the 100-day moving average, we talked about adding some support, adding some equity to the portfolios, which we did. And since then, the markets have really remained kind of consolidated on this sideways pattern. Over the last 2 days, we've retested the 100-day moving average here twice in a row in 2 days, rebounded off of it. That's good news. That just continues to confirm the support level at the 100-day moving average. Unfortunately, we've been unable to get above this resistance level, above where the markets have currently peaked last week. So we still remain stuck here. So over the next couple of days, maybe tomorrow's the day, I don't know. I kind of suspect it won't be, but we could get a breakout tomorrow above this resistance level. If we do, that's going to be good. We can add some additional exposure to portfolios like we've been talking, put some of that cash back to work. If the market doesn't, we may be stuck here for a little bit longer. Of course, the bigger risk is ultimately that the market potentially might break down and retest the 200-day moving average, which is currently trailing up down here right around 2,600, 2,650. So there is some downside risk here. I don't want to negate that, and this is why we're continuing to recommend holding a little bit of cash here, simply because we're not out of the woods yet. The markets haven't made a declaration that they are stronger and the bull market is back and we want to be fully invested alongside. There may be that point, but we're just not there yet. The bigger risk right now is the fact that we've got rising geopolitical risk, we've got rising interest rates, rising oil prices. All those are colluding at one time, which is an impact to both consumption and economic growth. Now, typically, markets don't respond well when you get a combination of three factors like that all happening at one time. And from the other standpoint of this, we talk about the benefit of tax cuts. We recently passed this tax cut and reform legislation, which is supposed to give the taxpayers more money to spend. That's great. Economically, they go out, they spend more money. That's awesome. The problem is that rising interest rates have increased the prices of mortgages and subprime auto loans and payments on variable rate credit cards. Rising energy prices have raised the cost of everything: food, transportation, gasoline prices. So any extra money I got from the tax cut is now being taxed away from me again through interest rates and through oil prices. So again, that's going to potentially deter further economic expansion in the short term, which with valuations very high here, we've still got a problem with the markets going forward of potentially lower rates of return. The other side of this is really talking about earnings. Earnings have absolutely gone parabolic over the course of the last month. Analysts have been ratcheting up earnings every single week. We had almost a $7 increase in earnings just over the last couple of weeks for the end of 2019. But the problem here is that with rising interest rates, rising energy prices, these type of things, that impacts profitability for companies. And now when you're talking about potential trade wars and tariffs and deficit reductions and these type of things as well, those also impact exports. Exports make up 40% of corporate profits. So anything that you impact at that level is going to reduce the level of profitability and earnings for companies. We just talked about yesterday on the show Walmart's earnings. 40% of Walmart's recent earnings that came in, good earnings by the way, but 40% of that earnings increase came strictly from tax cuts and repatriation. That's it, currency exchange. So if anything happens, a stronger dollar or an increase in inflationary pressures from oil and gas and energy prices and interest rates, etc., that's all going to potentially weigh on earnings. Now, the reason I bring all this up is because stocks are pricing in a very high level of earnings, and that leaves the markets very vulnerable over the course of the next 12 to 18 months to disappointment if earnings growth doesn't mature at this very accelerated rate that analysts are currently expecting. So, as always, the markets are valuing in and pricing in participants, you, me, Richard, John, all of us investors. What we do is we're valuing what we think earnings are today, and if we're disappointed in that at some point in the future, well, then that's when markets begin to reprice themselves. So just keep this in mind, and again, while the markets are performing better in the short term, longer term, we still have some real risk here. We're very long in this bull market. We're 9 years into this. We've got a very second longest economic expansion on record. And the reason that records are records is because that's where it ended previously. There seems to be this general consensus that we're at a record and it's just going to last forever. And as I just posted in last week's newsletter, which is on the website right now at realinvestmentadvice.com, the Dow Jones, as an example, since 1857 has only spent 14% of its time making new highs in total. Now, think about that. That means that a large majority of the time, 84% of the time here, 86% of the time, you're actually just spending time making up previous losses. So when people tell you this thing about long-term investing and just buy and hold because, well, the power of compounding. Compounding only works if you never lose money. Compounding is not getting back to even. So if you're spending 86% of your time just getting back to even, you're not making money. That's the real value of investing, and that's the important part about managing the risk in your portfolios and why doing things to protect against risk and incur and increase the value of your portfolio over time is so very important.